Here's something nobody tells you at your promotion party. A surprising number of the people handing you that new title aren't wealthy either. They have good salaries, nice cars, comfortable apartments, and very little actual financial freedom. Because a promotion, even a great one, is one of the most overrated wealth-building events in a person's life. That's not cynicism, it's math. And once you see the math clearly, the whole career ladder looks very different. Working harder for a better salary feels like the plan. For most people, it's only the beginning of one. And there's a difference between those two things that's worth understanding before you spend another decade climbing. From the moment you enter the workforce, the story is the same. Work hard, get noticed, move up, earn more, repeat. It's presented almost like a formula. More effort equals more promotions equals a better financial life. The story isn't wrong. It's dangerously incomplete. When you get promoted, something real happened. You proved value. You were trusted with more. Your salary went up. But there's a difference between feeling like financial progress and actually building wealth. And most people spend entire careers confusing one for the other. This video does the work of separating them. The problem isn't ambition. It isn't effort. Most people who hit this ceiling work harder than almost anyone around them. The problem is something built into the structure of employment itself, something that applies no matter how high you climb. And it starts with a number that almost nobody calculates. Start with the math, because it's simpler than most people think. When you work a job, you are selling your time for money. Every hour you work, you get paid. Every hour you don't, you don't. And it creates a ceiling that no promotion can break through. There are roughly 8,760 hours in a year. You sleep, you eat, you live your life. So realistically, even the most dedicated professional works somewhere around 2,000 hours in a standard working year. More if you're putting in exceptional hours, but the ceiling exists regardless of where it sits for you. A promotion increases what you're paid for each of those hours. It does not increase the number of hours available. So if you move from earning $30 an hour to $60 an hour, your income doubles, but you're still selling the same finite resource, your time. Economists call this linear income. The name doesn't matter much. What it means does. You can be extremely good at your job, extremely well compensated, and still be bound by the same constraint as everyone else. Time has a hard ceiling that no title can raise. So why don't more people see this? Why does a promotion feel so financially significant in the moment? Because something happens almost immediately after every raise that quietly cancels most of it out. Month after a promotion is revealing. Not because of what people buy, but because of how quickly spending adjusts to feel normal. The nicer apartment isn't a splurge, it matches the new role. The better car makes sense now. The commute is longer. The upgraded gym, the dinners out, the wardrobe refresh, each one is a reasonable individual decision. And none of them feel like a problem until you check the savings account 6 months later and realize the raise has essentially disappeared. This is lifestyle inflation. And it's not a discipline failure. It's closer to gravity, a force that operates on almost everyone, almost automatically, unless you deliberately design your finances to resist it. You don't need a study for this. Just find someone who earned $50,000 at 25 and $120,000 at 35. Ask them how much they've saved. The answer is usually uncomfortable, not because they're irresponsible, but because every raise brought a lifestyle adjustment that felt completely reasonable at the time. The apartment got better, the car got newer, the wardrobe matched the title. Individually, none of it was reckless. Collectively, it consumed the raise before it could become anything else. Think of your finances as a bucket. Income fills it from the top. Spending drains it from the bottom. A promotion turns up the tap, more income flowing in. But lifestyle inflation widens the drain just as fast. The water level, your actual wealth, barely moves. You're moving more water through the system. You're not storing more of it. And here's what makes this worse. The raise was already smaller than it looked. Imagine your company offers you a $30,000 raise. You tell your partner. You feel the relief. You start mentally planning what changes. And then the first paycheck arrives at the new rate, and something feels slightly off. The number is better, but not by as much as you expected. That gap between what was offered and what arrived, that's not an accident. That's the tax system doing exactly what it was designed to do. In most countries, the tax system is progressive. The more you earn, the higher the rate you pay, but only on the new portion, not everything you make. Your first dollars are taxed at one rate. The new dollars from your raise are taxed at a higher one. This is called your marginal tax rate, and it means every raise comes with a silent business partner who takes their share first, before the money ever reaches you. The exact figure depends on where you live and your situation, but the direction is universal. The headline figure overstates the real gain. And it gets more layered than that. Crossing certain income thresholds can affect tax credits, pension contribution rules, and in some countries, student loan repayment rates. The number on the offer letter and the number that changes your life are rarely the same number. Almost everyone evaluates a promotion in gross terms. They celebrate the figure on the offer. Very few sit down and work out what actually arrives each month. What you're offered and what you keep are two different numbers. Most people only ever look at one of them. But the tax calculation is just the financial cost of a promotion. There's another cost that doesn't appear anywhere on your payslip, and most people never think to measure it. Here's a question almost nobody asks when they're chasing a promotion. What am I not doing while I chase this? Pursuing a promotion isn't just an effort, it's a direction. Late hours, internal politics, performance reviews, skill development aimed specifically at what your employer values, all of that is real work. And all of it is work that isn't going somewhere else. Economists call this opportunity cost. Every choice is also a choice against something. And when you spend years optimizing for promotion, you're also spending years not building assets, not developing independent income, not putting money into investments early enough for compounding to do its job. The promotion path has a structural limit that most other wealth-building strategies don't share. Your upside is set by someone else. Your employer determines your salary band. Your manager influences your progression. The company's financial situation shapes what's available. You can affect the outcome. You can't control it. Compare that to investing consistently in a broad index fund over 20 years. Your returns are determined by the market, not by a performance review, not by a manager's opinion of your attitude, not by whether the company had a bad quarter. Or consider someone who gradually builds a small consulting income alongside their career. The ceiling on that isn't fixed by anyone's budget. These alternatives have their own risks and require their own effort. Nobody's saying they're easier. But on those paths, your ceiling is yours to push. On the promotion path, someone else holds it. The people who build real wealth inside careers almost always treat employment income as the foundation, not the strategy. They work hard at their jobs and they build something else alongside it. Not instead, alongside. People with real accumulated wealth tend to share three habits. Not income levels, habits. The first is that they own things that produce income without requiring their direct labor. Stocks, real estate, business equity, these are called assets, and their defining feature is that they keep working when you stop. A salary cannot do this. The moment you stop working, it stops. The second habit is the one most people argue with. It's not the size of the income that drives wealth accumulation, it's the percentage consistently saved from it, and what that percentage is then put into. For people with meaningful discretionary income, a consistent savings rate tends to be a stronger driver of long-term wealth than the size of the income itself. A person earning $60,000 and saving 30% of it will often, over a long enough period, accumulate more than someone earning $150,000 and saving 4%. Not because the lower earner is smarter or luckier, but because they're building an asset base instead of funding an escalating lifestyle. The higher earner is running a more expensive operation. More coming in, more going out, very little staying. Income matters, of course it does, but treating it as the primary driver of wealth is how people end up earning a lot and owning very little. The third habit is the one no amount of money can manufacture: time in the market. Compound growth, where your returns begin generating their own returns, is almost invisible in the early years. The numbers feel unimpressive, modest, barely worth tracking. Then a decade passes, and they start to feel meaningful. 2 decades in, compounding becomes the dominant factor in your net worth, often dwarfing the contributions that started it. This is why starting early matters more than starting big. An investment habit begun at 23, even a modest one, has something a promotion at 40 cannot provide: decades of runway. And runway, once lost, cannot be bought back at any salary. Notice what's absent from all 3 habits. A high income isn't listed as a requirement. It increases your capacity. It makes all 3 easier to maintain. But the habits themselves are available at almost any income level. The promotion helps. It just doesn't do the work. Everything so far has been diagnosis. Now let's talk about what actually works. The foundation is the least glamorous idea in personal finance. Keep a growing gap between what you earn and what you spend, and put that gap to work consistently. Almost every sustainable wealth-building approach runs on this same fuel. The gap between earning and spending is where everything starts. The practical problem is that this gap tends to collapse with every promotion. The raise arrives, the lifestyle adjusts, and within a few months, the new salary feels exactly as tight as the old one did. The most effective defense against this isn't willpower. It's removing the decision entirely. Automate your savings and investment contributions to increase the moment your income does, before your spending adjusts to the new normal. You don't feel the money leave. You don't make a choice each month. It just moves. Do this consistently across a career, and the difference in where you end up is not small. The second shift is harder to explain, but more important over time. Build at least one stream of income that doesn't require you to show up. This doesn't mean quitting your job or taking dramatic risks. For most people, it starts quietly, a regular contribution into an index fund, accumulating in the background while life continues. Over time, it might grow into a property that generates rent, a skill that earns consulting fees, or a small business that runs without your constant presence. The specific form is less important than what all these things share: income that continues whether you're working that day or not. Here's why this matters beyond the money itself. When your entire financial life depends on one employer's continued goodwill, you are permanently vulnerable to redundancy, to industry shifts, to a bad manager, to a company that decides to restructure. A second income stream, even a small one, changes that equation. It gives you options. And options, in the long run, are worth more than almost any single salary increase. The third shift is the quietest one, and the most consistently ignored. Most people plan to get serious about financial knowledge later, once they have more money, once life is less busy, once the promotion comes through. But financial decisions don't pause while you catch up. Every year you make choices about taxes, savings, and investments without really understanding them is a year of avoidable losses. Not dramatic ones, just the slow, invisible kind that compound in the wrong direction. Understanding how your money is taxed, how investment accounts work, what compounding actually does to your net worth over time, this isn't specialist knowledge. It's the operating manual for your own financial life. Most people never read it. The gap between what they earn and what they keep is largely built from pages they skipped. Chase the promotion, develop the skills, build the reputation. None of that is wasted. But know what a promotion actually is. It's an increase in your hourly rate. It's recognition. It's a resource. On its own, it is not a path to financial freedom. And no salary, at any level, ever really is. The people who build genuine wealth during working careers are almost always the ones who treat their income as raw material, not a finished product. They take the raise. They just don't mistake it for the destination. Here's the question worth sitting with after this video. If your salary stopped tomorrow, how long could your current financial position carry you? Not comfortably, just carry you. A week? 3 months? 2 years? For most people, that number is smaller than their career would suggest it should be. And the distance between that number and where you actually want to be isn't a career problem. It isn't solved by the next promotion or the one after that. It's a wealth-building problem, and it only gets solved by treating it as one. The promotion is a tool. Start using it like one.